Hello, my name is Taylor Lapidus. I'm with the Precision Team, Keller Williams Arizona Realty. Thank you very much for taking the time to watch our blog. Today we're talking about the Federal Reserve and how they are done buying mortgage-backed securities. For the last 15 months, they have been pouring cash, roughly $1.25 trillion, into the purchase of mortgage-backed securities. When lenders write loans, mortgages, and deeds of trust, they give the money to the homeowner, who then buys the home, using the home as a secured asset against that loan. The lender was taking that loan and combining it with many other loans into what are called mortgage-backed securities. They were then selling these packages of loans on the open market to private investors. People from China, from America, all the different people were sinking money into the banks to buy these loans, thereby allowing the banks to take that money and loan it to someone else, and it would create a cycle. Well, when the housing crisis hit, the credit crunch happened, and what was happening was that the banks were not able to sell these mortgage-backed securities. There was no more buyers. Everyone looked at them as too toxic. So they had to sit on these notes, which means that they were not receiving more cash, and they therefore could not give more cash out in the form of loans, and everything basically came to a screeching halt. The Fed came in and said, well, look, we'll buy these toxic assets. We'll become the buyers because there's no one in the private sector, and we'll start purchasing. They dumped in the $1.25 trillion over the last 15 months, allowing the banks to have more liquidity and start lending again. Well, as of March 31st, 2010, they are done. They're not buying anymore. So what effect is this going to have on the housing market? Well, directly, it looks like it's going to affect the rate that people are able to get on a mortgage. The 30-year fixed rate has been hovering at or below 5%. That's a very low rate. When you look back in the 1980s, when rates were double digits, you can see that there's a large discrepancy. With rates low, this incentivizes a lot of people to get into the market because you have more purchase power with lower rates, and start buying homes. This is part of what was helping bring sales to the housing market. There's a gluttony of sellers on the market trying to sell. This helped bring buyers into the game. Supply and demand, trying to get more demand for the abundant supply that was out there. So with the Fed not buying these mortgage-backed securities anymore, the question is the market healthy enough now for private investors to start jumping in? Some people don't think so. Some people think that Fannie Mae and Freddie Mac are going to have to step in and start buying up the difference that the Fed is not doing anymore. Now, Fannie and Freddie just announced in February that they were going to be buying roughly $200 billion in delinquent debt. That's going to help kind of cover this gap, giving us some breathing room. So it'll be hard to say exactly what the effect will be of the Fed dropping out at the end of March, which was the plan all along, and combine that with the fact that the tax credits are coming to an end after April 30th, really at the end of June, when those have to close by. So it'll be interesting to see what happens to rates, what happens to the market. Keep your eye on it. What do you think of the Fed dropping out? Some people think they've done too much. It's taxpayer money. This is a private problem. It should really be handled by the private sector. Others people think that they haven't done enough. What do you think? Where do you fall in this debate? My name is Taylor Lapidus. We are the Precision Team. We'd love to hear from you. Leave a comment below. Send us an email at myopinion@theprecisionteam.com. And have a fantastic day.